In recent days, we've seen heavy sell-offs in the Australian equities market, following equally heavy sell-offs in the US equities market. The reason given is fear of recession. I was I had to chuckle yesterday when I saw the report that 70% of economists believe that there'd be a recession. Now, I've been a professional economist for a long time, and I know a lot of other professional economists. And I know that when you have two professional economists in one place, you're going to have three opinions. It's really hard to get economists to agree on everything. So I somehow don't believe that the overwhelming majority of economists believe there's a recession. Got a couple of good reasons for that. One is that the US Federal Reserve has just updated its outlook for growth in the US economy, and it's reduced growth from a bit over 2% to about 1.7% this year, and the same again next year and the year after. And that's just below long-term trend growth rate in the US economy of about 1.8%. And that outlook allows unemployment to go up over the next couple of years and put downward pressure on inflation. Now, that's called a soft landing, not a recession. We're even further from a recession in Australia, where the Reserve Bank of Australia most recently provided a forecast that in its quarterly statement on monetary policy, the growth in this calendar year in Australia would be 4%, because we're experiencing a major commodities boom, and our commodity export prices are a little over 50% more than the average for 2019 and 2020. And we're looking at very, very strong growth this year, not recession. So if these central banks know everything, or know anything, it's hard to believe that either the US or Australian economies are entering a recession. Yet what we see is the Australian equities market, the ASX 200, is selling off really quite dramatically. So what we thought we'd do in a circumstance where, well, it's pretty hard to actually believe that there's going to be a recession, to what our model tells us about fair value for the Australian equities market. Now, the components in our model are earnings, which are pretty important, and earnings at the moment are pretty strong because resources earnings are pretty strong because, as we've said, commodity prices are more than 50% higher than the average for 2019 and 2020. And that's in a situation where the Australian dollar is still pretty low. So the profits that are being earned by resource companies are really very strong. And consensus earnings estimate don't show any near-term or medium-term weakness in those earnings. So earnings are pretty good. The other things that is a component in our stock market model is 10-year bond yields. Now, there's been quite a dramatic sell-off in US 10-year bond yields and Australian 10-year bond yields, but both have recently peaked in yield and are just moving down a touch. So, for at least in the short term, that sell-off seems to be over. But we've included that in our model. Now, the other thing that we included in our model is the measure of liquidity in the US wholesale market, because, of course, we're part of an international capital market. When we put all those things together, we can explain around about 91.7% of monthly variation in the Australian equities market this century, since the beginning of this century to now. It's about 23 years of data, including 1 year at the very end of last year, which we have in our model. So what that model tells us right now is that fair value for the Australian market is and this is, I did these update yesterday, 7,118 points, so a bit over 7,000 points, still fair value for our model. The market was 644 points yesterday, so that's 673 points below fair value. So that's just under 2 standard errors too cheap. Now, there have been periods in the last 20 years like this before. And the one that is much similar to the current level of undervaluation is the period of the euro area crisis in 2012 and 2013. Remember when Greece was thought to be going bankrupt and then was rescued, and there was a banking crisis in European banks, and they were rescued. So at approximately that time, you had this similar kind of fear that we currently have now. But circumstances were never as bad as they were thought to be, and the market rallied rapidly. So back then, the market got to a little bit more overvalued than it is now. It got to 780 points too cheap in terms of our model in November 2011, and 865 points too cheap in May 2012. That's 100 to 200 points cheaper than it is right now. And it took about 6 months for the market to base to find its low, and then rally off that level. How that compares to the current period is we can gain some insight by looking at what happens in the United States during midterm elections, this is a midterm election year. President Biden was elected almost 2 years ago, and every 2 years the House of Representatives gets re-elected, and half the Senate re-elected. We developed our system in Australia based on similar but not identical process here in Australia. So what normally happens during midterm election is the market sells off in May and June, as it has this year. It rallies a bit in July. It sells off again in August and September. And what's actually happening there during that period between May and June and August and September, it's finding a base at an oversold level, and then rallies very strongly when you get into the months of October and November. So that's what we think could well happen this year, that the market could find a base a little bit lower than now, not much, 100, 200 points, somewhere in there, and find a low. Take some more months to bottom out, but by the time we think we get to October, it'll be pretty obvious in the US that there is in fact no recession in the US economy this year, and the market will be ready to rally. Of course, I'm saying that based on my model, not on the basis of 70% of economists agreeing about everything, because I know that 70% of economists would never agree on anything, especially not a recession.